Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I am here to bring you some trading levels for the week of October 2nd, 2023. I'll be looking at some of the major market indexes as well as some highly traded individual stock symbols. Taking a look here at the SPY, which of course is the ETF of the S&P 500. This is what I was looking at last week. Okay, so this was what I was looking at on the 25th or so of September, or 22nd, I should say. And so this was a demand zone that we had been looking at here. And this essentially is a rally, a base, and a rally here. And so last week in doing this video, we were sitting right above this demand zone. And so the thought was price would come down into this, was most likely going to come down into this zone, perhaps stabilize, and then we might then start to get a bounce out of here. And we could see the distance here was obviously very close. This was about one half of a percent above this level. Okay, so that was what we were looking at last week. And so this demand zone here, an explanation of that is that this is an area of consolidation here where price essentially went sideways. And then there was an exhaustion of sellers here. Nobody was willing to sell here anymore after about 3 or 4 days of kind of an equilibrium in here. And then again, there was an exhaustion of sellers. And essentially the buyers then ran up the price chart until they encountered willing sellers. So that's the sort of the narrative of what occurred here. Okay. And the thought is when price returns to this level, this is still an area of interest where institutions and retail traders wanted to buy. And so when price returned here, we're looking for a repeat of this behavior because of this narrow consolidation and this energetic move out, which essentially represents, again, a sudden exhaustion of sellers. Okay, so that's kind of the narrative of what we're looking at in this zone. And that's what I recount here. It's an area of expected future upward price pressure created by a period of brief consolidation, a clear abrupt exhaustion of sellers, and then an energetic bullish move up. Okay. And then essentially then, well, again, we're expecting when price returns, we would get a bounce. Okay. So that was that's what I was looking at last week. So if we look at the live chart now, what ended up happening was since then is that price came down here. It wicked through midway through the week. I guess that would be Wednesday. And then we started to get a bounce. And then on Friday, it just kind of sagged back into it. So that's where the week closed. So, it basically, the SPY dropped about probably about 1% or so for last week. But this is kind of where we're sitting right here. So this zone is, now has been kind of tested. Not really, doesn't seem to be doing much, but that's the story with the SPY. Similar, we actually saw something similar though in terms of the Qs, the Nasdaq. So if I flash back to that, okay, this is what we were looking at last week. Again, a similar pattern here. Okay, so we had again this area of consolidation, this drop, a base, and then a rally there. Okay, we're looking at the daily chart here. Okay, you can see there's the daily chart here. And again, when price returned here, so again, we were hovering above this level, about 1% above, we were again looking for a bounce out of there. So if we now go back to the live chart here and switch this over to the Qs, okay, here's where, again, what I was looking at last week on the 22nd. And so we can see price then came into this zone, and then we got this, kind of little pop here, and now it's above this zone. It's really the same exact pattern that we saw with the SPY. It's just that this thing was offset lower. And so as a result, when price drove into here, it essentially had more of a cushion. And so essentially now this one is above the level, where on the SPY, it's kind of sitting in the middle of the level. But it's the same pattern and it's the same narrative here. All right. So now from where we are now on the Qs, we've started to move up here. If in fact we get some positive movement in the market, and that's possible, we may actually get this. Right now I'm recording this on October 1st. Yesterday, the Congress kind of got out of their own way and got their acts together, at least in the short term. And so they passed a 45-day continuing resolution that basically prevented the government from shutting down for the next 45 days. Obviously they just kicked the can down the road, and so come mid-November, we're probably going to end up right back in with the same drama that we had last week, where there was a debate whether or not they would actually continue to fund the government. But at any rate, tomorrow, when the market actually opens, we may actually see a little kind of relief rally that comes out of this. So we'll be looking for that. If in fact we actually get some positive movement in the market this week, I would say that we have about a 3 from where it closed on Friday here. We've got about 3% until we get up to this level here. Okay, and this is what we refer to here as a supply zone here. Okay, it's a drop, a base, and then notice that very bearish, energetic move, and then notice, of course, there was that gap there. All right, so it's the same exact narrative of what I showed you with the SPY, except on its head, of course. So in this particular case, this drop, base, and a drop here, this represents an exhaustion of buyers. Okay, so the buyers and sellers were in agreement within this, let's say, 3 day period. Okay, but then once price dropped out of here, the only reason that these trades occurred was essentially the buyers essentially were backing down the price chart, and so the sellers essentially had to run down the price chart until they encountered willing buyers, and that's how these candles and then basically ended up getting created. And of course, between that there was that gap. All right, so now we essentially had here. This was again that same demand zone that we saw on the SPY, just a little lower, and so again price dipped into that, and we got that bounce out of there. All right, and so this was the basis for for a bullish trade. So one, of course, could buy the Qs here. One could buy a call. Generally we prefer to buy a call a bit in the money, so that we're running a delta, let's say around 55 or 60, so that if you're right, you actually get paid off, and you're not buying an option that's way out of the money, which makes it very difficult to make money with. So at any rate, that's the sort of the basis and the foundation for using these demand zones here. So if price starts to melt up, we've got about 10 or 11 points here where it could kind of melt up to this supply zone here. And this would most likely be, we can think of this almost like resistance, where price is going to get up here, and then in fact it might actually get smacked down from here. And so again, this would be a place where one could actually then execute a short trade or some sort of bearish, an option position with a bearish bias. All right, so that's the story with the SPY and the Qs. All right, before I go on here, I just do want to just kind of do the quick disclaimer here. Everything I'm showing you here is for informational and educational purposes only. Precision Trading Labs, we are not financial advisors. We're not money management. Not money managers. None of this should be construed as investment advice. Again, this is for educational and informational purposes only. All right. If we take a quick look at the Russell 2000, the IWM. Okay. So right here, this is what I was looking at last week. Okay. And again, this is the last 5 days. Okay. Right here is was what I was looking at from here to the left. And then this is what transpired in the past week. Again, that pattern is exactly what we saw on the other two market indexes. I really wanted no part of this chart from the left. I had no desire to actually trade the Russell 2000, particularly on the long side, because in fact, if we take a look at the Russell here, and if we look right here, we can see the Russell. Here's the IWM, here's the Qs, and here's the SPY. This column right here represents the 52-week channel. Okay, so in other words, the SPY is sitting about 29% below its 52-week high. Here are the Qs. They're sitting about 21% off their 52-week high. On the other hand, the Russell 2000 is sitting around 61% off of its 52-week high. Okay, so on a relative strength basis, obviously the SPY and the Qs are far stronger than the Russell 2000. Okay, so again, from the perspective of going long, I really had no desire to really go long on the IWM during this past week, even though there is kind of a sloppy demand zone here because of the relative weakness of the IWM. This was this kind of nothing that I really wanted any part of. And again, as I put in last week, this whole region here is kind of a chop fest in here. And so really you want to try to avoid trading at levels that essentially lie within here, because essentially from the supply and demand perspective, most likely you're just going to kind of get whipsawed through here. So, again, it's starting to bounce here, but, it might bounce in sympathy with the Qs and the SPY, but on its own, this is actually kind of a really ugly looking chart. But again, we might just get you might just get a sympathy bounce from here because of the fact it's going along with other things. All right. So that's the story with the Russell 2000. Having said that, if in fact you do get a bounce out of here, though, right in here we have a drop, a base, and a drop here. And again, sort of a similar structure of what we were looking at on the other symbols. Okay, but this would be a good area from a short perspective, or from, let's say, a bearish options perspective to execute a trade up here. So you'd need this thing to melt up by about 3.5–4% until we reached here. But at that point here, one, of course, could express a trade by obviously shorting the IWM, by buying a put. One could buy a bear put vertical debit spread. And of course, one could also do a bear call vertical credit spread, where one would actually sell premium up here by selling a call at a lower strike and then buying a call at a higher strike in order to manage the risk. And of course, one does not want to be sitting with a naked call. So those would all be ways one could express a trade based off of this chart. All right. So if we take now a look at some of the other, a few other symbols that are kind of popular. Here's Google, and in fact, here's what I was looking at last week with Google. So right here, I was looking at this level here, and if I actually looked at this in the 2-hour chart, okay, this is the daily you can see of Google here. Okay, but if in the 2-hour chart, this kind of dropped into basically a drop, a base, and a rally here, and I'll show that to you when I actually go to the live chart. So when the price kind of spiked up here and then started on its way down here, this would be a region where one could express a bullish trade out of this demand zone. Okay, and so if we now go to the live chart here, we can see here's what we were looking at last week. We were looking at everything to the left. We can see on Wednesday. Okay, again, really the same pattern as we were looking at on those other symbols, and we actually then, of course, got a fairly, we got a bounce out of here. And in fact, if you look, let's say there's trading the stock, if I throw this ladder over here, okay, and basically put that at the front line of the zone here, we can see that price actually spiked up beyond 2-to-1 here. Okay. So in other words, this is 1 unit of risk right here. Here is our entry. Here would have been our stop out. And so getting right to here, this would be a 1-to-1 trade. That would be a 2-to-1 trade. And we can see it actually got up here. So this is about a 2.5-to-1 bounce before it started to drop back again. Again, we might get a sort of a relief, at least the start of a relief rally tomorrow because of the continuing resolution and the government continuing to be funded. So we'll see about that. But if in fact this thing starts to drop, this level is probably not going to hold anymore. Where we got a nice little bounce out of this once, this has probably chewed up all of the demand that was in here, because of the fact that it went all the way through to this level. That essentially means that all of the demand has probably been chewed up here, which means that if, in fact, this kind of thing pulls back and drops into this, in fact, we may end up then, this thing would actually end up dropping. And at that point then, the next thing that's going to stop it is probably this demand zone right down here, okay? So in other words, from where we are now at approximately 131, really that's about 10 points on Google that would come off. And so at that point then, this would look like that. So there's your 10 points right there, if it actually dropped from where it is now. And then that represents on a percentage basis about 7.5%. So That's what we're looking at in terms of Google. All right. Take a look at Netflix. Okay. Here's where we are now on Netflix. And so right here is a drop, a base, and a rally here. Okay. Again, this is what we were looking at on the 22nd when the last video got created, which was right there. Okay. And so this is what happened last week. And you can see this more or less, kind of looks a little like, the other patterns, except it never got anywhere near this demand zone here. So this is a live level here. This is actually a nice level here that, in fact, we could actually get a nice trade out of here. And in fact, if we look right here, here's the 200 period simple moving average. Okay. So this is actually, we have, in a sense, we have a confluence of kind of factors that all feed into this being a high probability trade. We have a demand zone here. That's number one. Number two, we have this thing is sitting at its lower Bollinger Band, kind of goes through this this region. So in fact, when price drops here, this will be sitting, just a bit above its lower Bollinger Band. Okay, that's three factors. Now we got demand zone, 200 period moving average, the demands, the lower Bollinger Band, and then it's confirmation of the lower Bollinger Band. This is the stochastic, and this is showing that in fact it's in an oversold condition. Its stochastic is sitting at around 6. And if you're looking at 20 as being an oversold condition, this is obviously right now well oversold. Okay, so if you sort of combine those four factors, this is actually an area where we could really expect perhaps to get a decent bounce out of this. So how would we express a trade out of here? One could of course simply buy the stock. One could buy a call. Of course, one could do a bull put vertical spread. Okay, and that would be essentially you'd be selling premium you would essentially sell premium to collect the premium there. And so at that point, then you would be selling a put, a higher strike put, and then you would and then buy a put at a lower strike again in order to control the risk. And so just as an example, right here. Now, this is what I had put up last week. I haven't actually updated this week, but one could basically, sell the October, which would be at around, which is now has about 19 days, 18 days to go till expiration, and then sell the 355, buy the 345. Obviously, now at this. All right, so let's take a look at the options platform here. So on Netflix. One scenario would be, in fact, to sell the 350, okay, and then buy the 340. So in other words, to buy this a bit higher, and also then to have that look like that. Okay, so you sell the 350, you buy the 340, and that would actually result in a premium collection of about 220, according to the estimate here. And so essentially, as long as this thing does not drive through the higher strike, this thing turns out to be a winner. So right now we are sitting right now at 377, and as long as this thing does not drive below 350, this is going to be a winning trade. And it's essentially we're going to have this demand zone here as a shield in order to protect it from the short strike. Okay, so that short strike, again, would be sitting just below this demand zone at 350. So this is the way we can use these demand zones in order to create profitable trades. Okay, and particularly they're very valuable both in terms of positional trades, in terms of getting good entries on a positional trade, but then also, again, they can act as essentially a shield when one does some sort of credit spread where you're trying to shield the short strike, which of course is where a trade, typically a credit spread will often go bad once the position goes in the money. So if we have this region right here that protects it, that's going to enhance the prospect of having a winning trade there. So that's the story with Netflix. And I think the last thing we'll take a quick look at is, let's see, was there something on Amazon here? So Amazon is actually, we have a 2-hour demand zone right here. It's kind of sitting here midway, and that's a fair distance away on both. So there's nothing really of immediacy here, although one could actually consider doing an iron condor here because of the fact that you're actually sitting kind of roughly midway between these supply and demand zones here. And so that would be another way one could express a trade here. And then let's see, take a quick look at Tesla. So Tesla, we actually got a bounce out of this level, and now we're sitting here. Right up here, there's a 2-hour demand, 2-hour supply zone here. I wouldn't be racing to short out of here. It's a lower time frame zone, so there's really nothing on Tesla, and I'm wildly enthusiastic about here. And then here's lastly Apple. So Apple is kind of hovering right above this demand zone here, and that becomes more apparent in the 2-hour chart. So I'll quickly pop up the 2-hour, and so this is that demand zone that's right here. So right here we have a drop, a base. Notice price goes sideways, and then we got that massive gap up here. Okay, so when price returns to this level, again, we expect that we're going to see a bounce out of here. So there was, a bit of a bounce that occurred here, but when price pulls back and actually hits this level, this is where we're expecting to see a bounce here. So that's approximately 2.5% down, and then up above here there's a 2-hour level that's sitting about roughly equidistant, about a little less than 2% up. So that's what we're looking at here on Apple. All right. So anyway, there you go. Those are some trading levels for both the major market indexes as well as some of those popular symbols that I mentioned. If you would like to learn more about supply and demand, and particularly how we can use them in terms of creating high probability controlled risk trades, and again, being able to, in particular, to produce quality options trades. There's a link in the YouTube description. Please click on it, and we can set up a call, and I'll be happy to tell you more about what we do here at Precision Trading Labs. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and I will see you next time. Take care. Bye-bye.